TheoTrade. This is Don Kaufman. It's July 27th, 2019, and you are watching the TheoTrade Weekend Update. Okay, central bankers, low interest rates, record stock buybacks. What could possibly go wrong? So just for a brief moment, let's talk about this past week of trade. Then we got to be forward looking. Why? Because we got the Fed coming. All right, this past week, a lot of earnings. Google absolutely smoked it, but really it's the stock buybacks out of Google that drove that price substantially outside of expected move. Now we heard all kinds of earnings. We'll break that down in a few minutes when we get to a couple of charts, a couple of trade ideas, because you know, in the prior weeks, we heard from like Caterpillars, we heard from, you know, some of the rails being trains, Netflix, the subscriber growth, but all of a sudden on the flip side of it, Google smokes it, Amazon, not so good. All right, we're all over the board in terms of earnings, and yet still some large earnings yet to come. But the key point and the key takeaway from this past week isn't so much about earnings, because quite frankly, it's a very clouded picture. All we know is that interest rates are low and the stock buybacks are going to continue. But the point, okay, really we need to pick up from this past week, it's all about the ECB, the European Central Bank. What did they do? A whole lot of nothing. All right, Mario Draghi came out, saw his shadow, 6 more weeks of winter, goes back and he hides for a while. The ECB, that's the European Central Bank, they didn't do anything in terms of easing, but they kind of set us up for easing later. However, again, our Fed is going to ease. They're going to ease probably by 25 basis points. But the point that I want to make before we get into some of the charts, some of the trades, the real point I want to make, okay, is my own expectations out of the Fed this coming week are not nearly as dovish as most would expect. So the Fed, I expect them to cut. I think everybody expects them to cut. The probabilities, I'll show that here momentarily, all expect a 25 basis point cut. Okay. Unfortunately, we just had a strong GDP. You know what's funny about that? I'm saying, unfortunately, we just had a strong GDP. Oh no, the economy actually looked strong last quarter. The Fed is very likely to deliver a little bit more of a hawkish tone, which is in turn going to send some shock waves probably through the bond market, which could actually reverberate into the equity markets. Bottom line with all of that, let's cut all of the geek talk out. Bottom line, the Fed ain't going to be as accommodative as people expect. Because they're not going to be accommodative in their language moving forward, the bond market is very likely to take a dump. You got to realize that the bond market is a very one-sided market right now. Everybody, okay, everybody in the professional world, buy bonds, buy bonds, buy bonds. And if you look at the bonds here, okay, in the US, and I'm talking about, you know, treasuries, notes, bonds, whatever it may be, our interest rates are still really high versus the rest of the world. We're talking about Japan, we're talking about Germany, we're talking about really anywhere in Europe. So net, okay, I think actually our interest rates are going to go soaring a little bit higher in the near term. Long term, rates going to go down, okay? Expect those rates to go down long term. Short term, again, the Fed this week, I'm making kind of a bold statement over here, the Fed this week comes out, when I say a little bit hawkish, again, they're not going to be as accommodative moving forward, and that might send some shockwaves through this marketplace. The last point I want to make, and I'll show you in some of the charts here, the S&Ps, they finished up this past week. They actually clipped the upper edge of the expected move after last week clipping through the lower edge of the expected move. What does that mean? The marketplace is doing a horrific job, okay, of handicapping risk right now. Specifically, the options marketplace not doing a good job of handicapping risk. Think about that, whether you're going to be on the buy side or the sell side. Again, we're going to talk about that here momentarily. With that, let's get to some of the charts, some of the trade ideas. To some charts and trades we go. Of course, our theme this weekend is central bankers, low rates, and record buybacks. What could possibly go wrong? Which actually leads us to our first area that we're going to discuss here in terms of some trade ideas. And that has everything to do with right here. That's earnings reversals. Facebook, Intel, McDonald's, 3M. These were great opportunities on an intraday basis. So I'm going to start with a little bit of intraday discussion, and we'll actually backtrack and come back to earnings in general. Let's actually cruise over and display just that. Facebook, okay? First and foremost, we'll bring up Facebook. Now, Facebook, and we'll bring up the broader chart on this, happened to have a very wild reversal off of the top end of the expected move. So earnings came out Wednesday. The stock jumps exactly where it was expected to jump and then reverses off of it again, creating a very, very advantageous trade. It's not just Facebook. Take a look at Intel. Okay, Intel, the exact same story. All right, peaks out. By the way, Intel released on a Thursday evening. Peaks out in the after hours, full-fledged reversal. Now, the question, okay, for intraday traders is when would you have executed the trade? And that has everything to do, of course, with the edge of the expected move. However, okay, moving forward, I want to see if some of these reversals are going to gain a little bit of steam. That is, right, are we going to see continuation to the downside in terms of Intel, in terms of Facebook, McDonald's? Again, this is all relatively, okay, similar trade opportunities that existed. Again, McDonald's, okay, spikes higher, wild reversal after the hitting, if you would, the edge of the expected move. Last but not least on this happened to be none other than 3M. Now, this is not per se me saying that, oh, the tide is turning over here, okay? This was an overzealous marketplace that clearly pulled in substantially, okay? Nevertheless, it was more about the trade opportunity. I'm not trying to display stocks that are just reversing for the reasoning that the market is going to reverse. This is simply great intraday trading opportunities, and these four underlyings fell into that category of those trades. The question is, moving forward, are they going to continue to actually see some sell-side activity? Well, that remains the question. Nevertheless, these kinds of reversals on an intraday basis, they're just gold for those of you that do trade on an intraday basis. Next, we're moving on to earnings-related butterflies. Now, we hit two of these butterflies. This is something I detailed a number of times in this previous week on the videos. In fact, talked specifically about Snapchat, talked about Caterpillar a little bit. On Snapchat, this thing came out after earnings, tagged the butterfly. Now, the middle of the butterfly was 1650. You did have to exit this trade a bit prematurely. Now, butterflies, they don't maximize, they don't completely, okay, come to fruition until much closer to expiration. Nevertheless, we were up between 300% and 400% on the butterflies. The volatility came out after earnings. We were up substantially and we're able to exit, okay, a number of contracts, okay, in our favor. It was a strong trade inside of Snap. Next, Caterpillar. And the reason I'm detailing these trades from last week is, well, I'm going to be placing more of the earnings-related butterflies. Cat, we had a butterfly, okay, smack on the 130 strike. We actually had a 130, okay, all the way down to the 127, and the upper side of this is 133. This butterfly, okay, was right in range, and we're able to pull out over, okay, $1 credit for this particular. It was a $3 wide butterfly. We exited it well before expiration, still made over $1 though on that particular butterfly. Again, the reason I'm detailing this, there's a whole lot of earnings still to come. Look for some earnings butterflies this week. I'll be covering them Monday, Tuesday, Wednesday, live in the TheoTrade chat room. All right, enough of the earnings. Again, earnings of just a wild mixed bag of goods, which again, I'll kind of come to here momentarily. Before we actually get there, let's actually talk a little bit about the Fed. The Fed, it's up to bat. And after the ECB did a whole lot of nothing, okay, well, what do we expect over here? And did we mention how strong GDP was? All right, so GDP comes out on Friday. I wouldn't say necessarily shocks the marketplace. Just a quick glance here on an intraday basis. GDP, okay, it moved markets, but the markets that it moved were effectively the bond market. But the bonds, okay, have really been stuck in a rather tight channel. Now, this is the point of me talking about the Fed at all. Most of the Fed talk out there, okay, what's it worth? Absolutely nothing, okay? I kind of gave you my feelings a few minutes ago. The Fed's going to come out, right? And they're very likely to do what? Lower rates. In fact, if you want to stick a probability to that, okay, this happens to be the CME group, and they actually put probabilities to the Fed fund futures. And right here, okay, that's the probability, if you would, of lowering by 25 basis points. Now, there's still like over a 20% chance. People actually think they're going to cut by 50 basis points. I would put that on a wing and a prayer that they're going to cut by 50 basis points. Nevertheless, okay, the point of me coming in here and actually talking about that isn't to tell you what the Fed is likely to do. Listen, they're going to cut 25 basis points. My projection, though, moving forward, these probabilities are going to move substantially, okay? What I'm saying is the Fed might cause a little bit more of a hawkish tone. That is, they're not going to be as flexible, not going to be as accommodative as individuals may think, which, again, moving forward, it's going to send some shocks to the marketplace. Which marketplace am I talking about? It's the bonds. Okay, if you're looking for trade opportunities in here, cruise over to the TLT. The TLT, you know, yes, you can trade the ZB. Yes, you can trade the ZN. I find the TLT, it's, well, easier for a lot of clientele to trade. It's a much more client-friendly product. So what I've actually done in here, and I've done this in a number of ways, is I'm actually placing just a really straightforward kind of back ratio. And that trade is still totally up for grabs. Now, because of the implied volatility skew in TLT, and I don't want to completely geek out on people here, but because the implied volatility skew, all right, what a ratio back spread is, for example, we're selling this option, okay, and we might be able to buy two of these options a little further out of the money. And the reason we're able to do that, you're selling right around a 10%, you're buying about a 9.9%. Listen, that doesn't sound like a lot of difference, but it's enough, okay? It's enough to make these ratio back spreads favorable. So how do you set this little monkey up over here? Well, I sell the 131s, turn around, for example, and I can go out and buy two, okay? Two of the 128 puts. It's about a 7-cent credit. Now, what's going to happen in here? Well, I'll tell you exactly what will happen. Look at the chart. If the bonds go up, you get to keep your 7 cents. If the bonds go down and down massively, okay, well, you've got profitability. That's it. And I'm not going to go into the risk graph. I don't want to go into too detail. And yes, there is a spread in here, okay? And you do have to put up a little bit of margin, about $3 of margin, minus the 7 cents of credit in here. Again, this is a type of a ratio back spread. And because it's, the skew is favorable, I don't have to get crazy. I don't have to get cute. I don't have to use a risk twist spread. It's as straightforward as can be. It's a ratio back spread, looking for the possibility of bond shocks. And when I talk about bond shocks, that's something, hey, listen, this is what a bond shock is. We're cruising along out of nowhere, boom, right to the downside. And that's the kind of move that could make a really substantial sum. And quite frankly, I'm not putting a whole lot at risk in this. Right? And like, where do you see a lot of risk? Okay. To exit this trade is key in effort to minimize the risk. Something I'll cover, of course, in the TheoTrade chat room. All right. Onward and upward we go. So again, the Fed's up to bat, and listen, block out all of the talk. It doesn't make a difference. Okay. My take, more hawkish, go after the TLT, and don't get too cute over here. Don't put a lot of risk up front. Just use things like ratio back spreads. All right, onward and upward, back over to the earnings discussion. Caterpillar, the rails, Netflix subscriptions. There are some really definitive signs, okay, of the economy weakening, but you wouldn't know it. And you wouldn't know it when you start to hear the earnings out of something like Google. There's the virtual economy and there's the real economy. The real economy, again, companies like what? Caterpillar. When I say the rails, I'm talking about like CSX, right? Like Union Pacific. There's been some not so good numbers, and some of the businesses are absolutely unequivocally slowing down. But then you look at Google, and the Google had an absolute blowout. Ironically, though, on that blowout, there's still a bit of a reversal again on an intraday basis after that kind of blowout on earnings. Google at times was substantially higher than it effectively closed. Nevertheless, it's almost like a tale of two totally different marketplaces over here. All I'm saying in this front, keep eyes on it. Okay, the divergence is just growing and growing and growing. And if you're not familiar with companies like a Caterpillar, okay, the earnings, all right, stock actually sold off, bid back up a little bit. If you take a look like CSX, got absolutely walloped. Netflix, obviously, we realized closed well outside the expected move. All right, moving onward and upward. There's a trade that I talked about quite extensively in a recent update, and that had everything to do with a Russell's pairs trade. Okay, it was Russell versus Q versus the spiders. In fact, I don't mind taking you back into it for just a second because this trade is in motion right now. What you're looking at here, and I'll close up this left side bar once again, happens to be a comparison chart. On the top, what do we have? The QQQ, right smack in the middle is the spiders, and on the bottom over here, that's your Russell. Specifically, this is IWM. All I wanted to show you here is that IWM is starting to close the gap between it and the spiders and the Qs. Enough said on that front. Okay, the pairs trade is gripping hold. The pairs trade is starting to work. And it's really one of the more unlikely scenarios over here. That is, it's the Russell actually bidding up. I expected the Nasdaq to come down, but hey, the day is young. All right, let's again onward and upward over here. Interest rates are low forever. Okay, but someone forgot to tell the financials. Next point I want to make over here has everything to do with the financials. Now, I've mentioned this in some of the videos, but therein lies, I think, a decent duration trade opportunity, okay, inside of the financials. Now, whenever I say duration, I'm talking about just that. When I say duration, okay, this is a longer term take. This is not like an overnight kind of trade. This is not a couple of weeks. We're talking in excess of 3 months, 6 months, a year. Listen, when it comes down to it with the financials, okay, the financials have had a spectacular run. I mean, really, ever since the election, okay, the financials, what do they have? They had deregulation. They ripped apart part of the Dodd-Frank bill. Gold, right? Then they actually had what? The tax plan, the change in tax plan. Oh, unbelievable. Then the financials had the Fed come out, and the Fed actually lowered the restrictions on the financials and allowing the financials to buy back their stock. Wait, it gets better. Then the Fed raised interest rates. Everything has been going the financials direction, except the one thing that I can't explain right now. And I don't mind saying that, okay? Look at the financials since the beginning of the year. Except right around here, they talked about we're not gonna raise rates. Now we're actually going to lower rates. Do you see? Okay, the financials is not doing so well because I sure don't. Interest rates are net going lower. Now, I just said that interest rates, what? Well, the interest rates are probably going to go up a little bit after the Fed announcement, but net over the duration. And by the way, when I say over the duration, again, we're talking a little duration over here. Go take a look at the TNX. The TNX, this is the 10-year. Forget like a shorter duration chart. Pull it all the way up, okay? Are we starting to see a little bit of a trend in this? Interest rates, like this is the 10-year. It's going down forever, yada, yada, yada. Our rates are still really high, as I said, to the compared to the rest of the world. But it's all right now about the financials because I'm telling you what I can't explain. Take a look at the financials. I'm going to pull up the auto expected move. These little monkeys burst outside of expected. Burst outside of expected almost by what? That's a 1 deviation move. This is almost a 2 deviation move outside of what was expected this week. It's a phenomenal move in the financials. And I'm going to tell you right now, I think this is going to be the short opportunity, okay, in the coming months, possibly years. Because again, there is nothing that is going to convince me as a trader, as an investor, okay, how are the financials going to get the wind at their back? They're not. Everything that's coming, okay, for this sector, headwinds. They're going to lower interest rates. That is not going to help whatsoever, okay, with these financials. And right now, the yield curve is so ridiculously flat, it's kind of hard to borrow money and lend money out when the yield curve is flat and make anything on it. Investment banking isn't going that well. More and more stocks now are going, IPO, but they're doing direct to market. Again, it's a tough, okay? It's a tough world out there, and the financials, they're going to feel it, okay? If you've got a reason, how did the financials bid up other than the rest of the market went up and the rest of the marketplace went up? The financials went up, okay? The only thing the financials have going for them is that they're buying back their own stock. Now think about that for a second. They're buying back their own stock, okay, in a lowered interest rate environment. That doesn't sound like a very good idea. Nevertheless, the financials, obviously, I am not by any stretch of the imagination bullish on them moving forward. All right, last but definitely not least, let's actually pull up the SPX, because the SPX kind of astounded us the last 2 weeks in a row. And I didn't spend that much time on it last weekend. Okay, I'll be rather brief over here. Bottom line, the SPX, that cracked outside of its expected move. That's the previous week. This last week of trade cracked outside of its expected move. This stuff is habit forming. Okay, it's habit forming. The SPX is exceeding what the options market is depicting that risk to be. But here's like the kicker, the irony, if you will. So in the previous week, there's over a $40 expectation of movement, right? So here we are. When I say a $40 expectation of movement, you're supposed to move just over about $40 here. This next week, okay, this is the coming week, there's about a $38 expected move. So we crack expected move, but then they diminish volatility. Volatility gets diminished when we're cracking expected moves. Again, doesn't seem right. All I'm saying, okay, if you're index related, you want to be long gamma, meaning you want to be a buyer of options. Okay. In fact, coming around earnings, even around earnings, buying options has been working. I mean, look at the stuff like on Google and Netflix. If you had bought options, okay, on tons of different earnings, just Google and Netflix, okay, would have made tremendous amounts of profitability out there. A lot to think about in this weekend's update. Okay, look for some trade opportunities this week. I will be bringing those trade opportunities to you all throughout the course of the week, live in the TheoTrade chat room. Have a wonderful weekend. Bye-bye.